Yo, this is Kenny Coins with Marathon Money. You already know future one percenter. We're here with Derek Miller. Am I saying Derek Miller, right?
Derek, you got it. That's
Yeah,
right, Kenny.
man. Derek, I know you've been in the finance world for a while. You're an entrepreneur. You do a tremendous amount of things.
Yeah.
Um, I've seen some of your videos. You talk about stocks. I seen you talk about finance. I did do a couple research on you. I see you got your hands in multiple pots.
Yeah.
Um, but I think you're like one of those guys that are like perfect for the show. Like,
Awesome.
so I think a lot of people would like to hear what you got to say. So
Cool.
let's
I mean,
hear it.
as you said, like I do a lot of different things, right? I mean, I have a live broadcast every day. I focus in on finance, like the investment portion of finance a lot on that live broadcast because it's just me. So, what I find myself doing, I mean, I'll talk about my experiences with finance and some of that basic financial planning, but the goal of that part of my life is really just to help people understand how a market really moves and what are the true influences of a market, because if you can wrap your head around that, everything else will start to make more sense. But like you said, I mean, I do business consulting, right? I was a stockbroker, a financial advisor for 17 years, a trader for 25 years. So yeah, I do a lot of things and I'm always open to new things, which which brings us together, Kenny. It brings us together.
Man. And like, I think that's all that stuff that you said is amazing. Um, And one thing, before we press record, we had a conversation about, my initiative to do these marathon of interviews. And I'm meeting a lot of people who are wealthy or doing good in their career or have this extremely wealth of knowledge that is not really shared with the world. And you said that, of course, there's a lot of people in that world that you will never know of, and that brings a particular two words in my mind: silent wealth. And
Right.
that's pretty much what that is.
there's there is so much silent wealth. I love the term, by the way. That's a great way of putting it. There is so much silent wealth out there, and I don't think the average person realizes it, because I don't think the average person really has any idea that they think of a financial advisor as this big kind of position within the financial world, and really, you're like at the feeder system of investment. So to do half a million, 25 million, 50 million a year, these are things that if you want to make headlines making that kind of money, you can, because you can put yourself out there. But there's a lot of guys out there that they don't want their name out there. That's not their interest. Their interest is to sit down every day. They understand different derivatives markets, right? Like people focus. Maybe you're a futures guy, maybe you're an options guy. You can easily be both. I find when you start getting into derivatives, it's best to be in one or the other because they do move in very different ways, right? But those guys that are doing that, if they're doing it professionally, it's not the 25-year-old kid sitting on TikTok talking about support and resistance. Not that that doesn't play a role, right? I mean, there's mechanics inside this business. This business is trillions and trillions and trillions of dollars. There just aren't other businesses that exist that have the kind of money that finance has. Therefore, if that's the case, anybody in that business, even if you're mediocre, is going to do very, very well if they understand how that business works, right? Most people think of it as this stock exchange with fair play, right? There's a buyer, there's a seller. And that's true. But if the seller is a big institutional trading desk, a big institution, or even a small institution, and they're selling off blocks, 100,000 shares at a time, and you're over on Reddit, selling 5 shares, there is a seller and a buyer, but believe me, one of you has a lot more influence than the other one. And I think that's something that gets lost in this. People think of most businesses kind of the same way. It's supply and demand. I used an example the other day, Kenny, where it was just about t-shirts, because I try to make it as simple as possible. I said, you own a t-shirt shop. This t-shirt that you made, it goes gangbusters. Everybody's like, that t-shirt's dope. I want to have it. I love it. I want to get it. And so all of a sudden, this particular t-shirt starts flying off the shelves. Well, what are you going to do as that business owner? if that t-shirt is flying off the shelves and demand is through the roof, you're going to raise the price of that shirt. Why? Because you can, and because it's a business. Now, you'll reach a point at which that shirt has become more expensive than cool. And at that point, demand is going to dry up. Sales are going to drop. And you're going to have to do what? You're going to have to start dropping that price again until you find that sweet spot in demand. That is exactly
discount.
Right. Yeah, you got to start discounting that thing because you want demand to pick back up, right? Well, it's that simple when it comes to the stock market. If you're an institution and you have millions and millions and millions and millions of shares of this company, and demand all of a sudden happens, there's this demand. And typically, that's just retail investors getting really excited, whether it's Tesla, whether it's NVIDIA right now, it's market sentiment on the less knowledgeable. I use the terms, Kenny, less knowledgeable, more knowledgeable, strong hands, weak hands. It's just a way to indicate who's on what side of a trade or a position. And when the weak hands or the less knowledgeable hands get excited because emotions rule people and they're not disciplined and this isn't their business, so their emotions rule them, they go all in. And what happens? What does the t-shirt owner, what does the guy that has all that stock do? He bids it up until it reaches a point that no one is longer interested. And that is when things reverse. Why does it reverse? Because we need to create demand again. It's not as complex of a system as people pretend. It's simple supply and demand that then controls price, right? But if you don't know that there are players in this game, the business of the stock market, you don't realize that there are, if you don't know what institutional trading desks are and how they work within a brokerage and how that works within a bank and how that bank makes money, how are you going to make money doing it? And so my goal every day is to just one or two people, if they just go, wait, that makes sense. That I get it. Every time my advisor has me buy a position or whatever, it seems to go up 5 and 6%, and then it reverses and I lose 20. Why? And there's a reason for that. And I won't get into that. That would be a long, I would go on and on, Kenny. It would take a while. But there's a very, very good reason for why that happens and why it happens consistently. And so that's what I try to teach people, the business of this. And within this business, you're a business person yourself. And being an entrepreneur for 25 years gives me a pretty unique perspective. And because I am an entrepreneur, I also don't have to play nice. So I can just say it like it is. And I don't have to worry about it because nobody can touch me anyway. Not with how I make money.
Yeah, they don't sign your checks.
I mean, right? That's the key,
they don't
right?
sign your checks.
Yeah.
Just to get more into this topic of the stock market, and I got like a few more questions to ask you on different topics.
Sure.
2 days ago, you posted that you think the month of September is more likely going to have a market crash and a big market reversal. Like, why?
No, the opposite.
You think the opposite?
The opposite.
You don't think?
So what I said, just to clarify that, what I said was that most of the talking heads, most of the guys on Twitter, most of the guys, if you're tuning into like CNBC or Bloomberg or whomever, they're going to talk a lot about market crashes, a lot about market reversals in September. Why? Because that month has the highest probability of any other month of the year for something like that to happen. And because that is something that happens in September so frequently, it gives, again, the stronger hands in the market, the institutional traders, an advantage to put that news out there, to drop the market 2%, 3% on day one of trading in September, and follow up with a couple more 1% down days to make that fear become realized. And the reason I say that's what's going on now is because you can always see a setup to a market reversal or a market crash. And you can see it on any time frame you're interested in. So if you look back at 2008, 2009, for example, which was like a global economic event, the market actually started pulling down early summer of 2007. You could argue even spring of 2007. We didn't have that first market crash until the market was already down 22%. And it was a year and a half later. That's how long those institutions knew that 2008 was coming. That's how much stock they had to offload. It took 18 months before they walked away and said, let her rip. And that is what has to happen in any reversal. In 2021, for example, that was another reversal that I almost nailed to the day. So it's kind of a cool topic for me. And it was in December of 2021, you saw volume or trading activity during a holiday season go up 500% compared to its average volume across the board in markets. That means trading activity is going through the roof. Who can increase trading activity at a level of 500%? Only professionals that are sitting at desks, that are sitting in these institutions. Now, something I get a lot, Kenny, and questions I get a lot because everybody loves conspiracy theories nowadays. It's like fun, right? Like even I dig it. I love it. Like it's fun to listen to guys talk about it. And it's great. But there's no conspiracy here. These guys all go to the same schools. They work at the same shops. They switch jobs just like anybody does. If you're in finance this year, you're at Wells Fargo, your buddy goes to Goldman Sachs. Goldman will give you a little more money. You cruise over there. Then Bank of America, your other buddy works over there. He said, hey, man, listen, they're offering this over here, and the bonus is like twice what you're getting now. You got to jump over there. You just all know each other. It's just a world. It's an ethos. It's an ecosystem. And so naturally, the way you and I are talking right now, they talk. And they watch each other and they tell each other, yeah, we had some big orders here. We had some big orders there. And other people sort of follow suit. And next thing you know, you have trading activity bumped at 500%. And when someone like me sees that, I go, well, this is easy. Okay. There's some kid on Reddit didn't do this. Like so Schwab didn't do that. Like some trader at Schwab or Ameritrade didn't do it. So I know who did do it. Right. And right now, Kenny, the reason I put that video out is because right now there's none of that. That's not happening, which means nothing is being offloaded. Shares aren't being sold. So institutions aren't selling. If they're not selling, you shouldn't be selling, which is really the reverse of August 5th, when the NASDAQ opened up down 5.5% and the S&P 500 opened up down 3%. Out the gate, volume was screaming and through the roof. My video, if you go back to August 5th, that very morning, was titled intentionally, this is not 2008. And I told everybody to buy everything under the sun. We're going to have a 30% rally off of this because you could see it. You can see what they're doing. And so actually, Kenny, just like I could see how that might have been confusing, but I believe the opposite is going to happen. But I believe it's a great topic right now. Talk about crashes, reversals, and you have a 1 in 12 chance of being correct and the highest probability of that being correct right now. So why not? It's why people like to be bullish. It's why a lot of professionals love being bullish. Well, you're right 80% of the time.
Yeah, that is true. Because the market all does. If you look at the market on a long standpoint, it does go up.
It does. I mean, so
Yeah.
if you look at the numbers, 80% of the time it's going up, 20% of the time it's going down. What's unique about the market is the manner in which it rises 80 and the manner in which it falls the 20. So the falls are precipitous and nasty and mean. It wipes out the gains in 1/3 the time of the rise, right? But here's an interesting fact I used to tell people when I was a financial advisor and I first got into the business. I was only 24 years old. And an interesting fact that I told people when they would ask why would they hire me, I would tell them that, from 1990 to 1999, the S&P 500 averaged a little over 11% per year. However, the average investor person only averaged 1.2% per year. So there's nearly a 10% differential in what the S&P made and what the average investor actually made. And why was that? Because they don't know enough. Therefore, they react emotionally to what goes on in the market. They're buying at the wrong times. They're selling at the wrong times because they act on emotion instead of discipline. And so when I first got started and people would say, why would you hire me? I would tell them, look, I'll stop you from making an emotional mistake. I don't know how to trade better than a mutual fund because I didn't. I was 24 years old. I don't know how to do better than a professional money manager, but I do know how to do this. I can control you making emotional mistakes. And so I think that's a huge component of the markets today as well. And it always will be, right? It's the
I
same
think
reason.
today is more emotional. While we're on that topic, I think today
Yeah.
is the most emotional market you would see than ever before because the barrier of entry into the market is extremely low than what it was 30, 20, even 10 years ago.
I can't agree with that statement anymore. I mean, that's you hit the nail right on the head. I mean, I completely agree. I mean, so which is a good thing and a bad thing. It's a good thing and a bad thing because when you're young, you want to make money and you want to make it fast, right? And we have seen that in the options and futures market, which have increased in volume by like 500% over 6 years ago. Like incredible amounts of volume has increased in those two particular areas. Now, I did a video on this, I don't know, a few months ago where I said, is the increase in that volume due to sophistication or gambling? So is this people becoming more sophisticated? Because those instruments are amazing tools to utilize leverage to keep cash in hand. Like if you use them correctly, they're amazing. But here's the thing. I mean, I wouldn't have touched those markets for a decade after I got started. They're too complex if you don't know what you're doing, and they're too fast. And they will eat you. They will eat you up. So what I came down to in the end was it was sophistication, but it wasn't US sophistication. It was in India. 80% of that volume comes out of India, and they're getting really sophisticated over there with how markets move. And because a lot of them are really poor, they can use these instruments that are packed with leverage. And as long as you're smart and you know what you're doing, the barrier to entry is small. It's like there's literally no barrier to become an investor anymore. And
The
there's all
door is pretty much paper thin now.
paper thin. You can walk right through it. But the cool thing also that goes along with that is the barrier to get into higher socioeconomic classes is also equal. It's equally as thin. You just have to make sure you learn enough first. And too many people are just jumping in head first. Like, this is easy. It's like, no, whoa. That's
That's
exactly
why,
what it's not.
yeah, that's why majority of people that becomes like they say, oh, every day 10 people become millionaires, but they don't, you see the article of that every day 10 people become millionaires, but they don't, there's the other side of it. 15 people lose all their millions too. So it's like it's actually at a negative number.
I would think
So
so.
yeah, it's if you look at it and you look at the opposite side, it's like, okay, 10 people become millionaires every day, but then 15 people lose that status and become in debt. So it's like it's at -5. So really nobody's really becoming millionaires.
I don't know, like I didn't know that statistic, but I don't have a hard time believing it because
Yeah.
I have my story is unique in the sense that I started off as purely an entrepreneur, running my own businesses by the time I was 18. It was a landscaping company. And then I ended up in finance through that company, which is an interesting story in itself. But when I became a financial advisor, the cool thing about being an advisor to people is I looked over, I don't know, probably 1,000 portfolios over my lifetime. So a lot of people when they're trying to do their financial plan, they think, why would I want a professional to do a financial plan with me? I know my life better than they do, right? But here's the thing: I've looked over 1,000 lives. I know 1,000 ways you make mistakes. I know a
Yeah.
1,000 ways that you're benefited. One, yours.
Yeah.
So there's a benefit there. But I will tell you this: when it comes to trading and investing, and I mean this, and this goes for everybody out there that would be listening or watching, everyone's lying to you about what they actually do in their trading account.
Yo,
I
yo,
cannot
you
tell
can,
you
yo,
everybody. I mean everyone. I in 15 years,
it's so
upwards of
accurate.
1,000 people, I can
So
tell you that
accurate.
I met one person that told me the truth. Everyone else grossly lied, knowing they were going to sit down with me. So if
Yeah.
they know they're going to sit down with me and I'm going to review this and they're going to lie to me in like massive ways, what do you think your friends are doing to you, knowing you're never going to be able to find out?
Yeah. Dude, man, it was one of the like, and you know what's crazy is like you look at the account and it might have like millions in it, even 100,000. And it's like, you still got a couple million. Why lie? It's like it's okay if your portfolio's down, man. It's like there's no need to come at me and tell me you're up this much and you're doing this. It's like you're not. You're here for a reason.
Right.
And And your heart, that like that statement is so accurate. Even if they're doing like well in life, they like grossly like because nobody wants to say they're down 30%. Nobody wants
Right.
to say that.
Because they think they're attaching ego to performance. And a lot of times these guys aren't even at a place to have ego based on performance. They're not even at a place where they should even have any. They should be they're brand new babies in this thing. There's no reason they shouldn't have an ego yet. They should be like, look, man, I messed up. And look, there's plenty of people that will do that. I'm just telling you, there's the other side, and they're far
Yeah,
more predominant. They're like, no, I'm a buy and holder. I go, great. We sit down, I look at what I said, you sold everything, March 6th of 2009. The bottom was March 9th of 2009. What do you mean that you buy and hold? Well, I bought back. Well, you bought back 50% later. That's not what buying and holding is, right? Oh, I'm a trader. I crush it. I go through it. It's like, look, your short-term trades here look like you lost a little over $1 million last year. They're like, yeah, but did you see the year before? I go, well, yeah, it looks like you made 1.2, but then you deposit another 300. So you're down like $500,000 right now. And oh, well, yeah. It's so you go, look, we don't have to pretend here. I can't help you. I mean, I can't. In that scenario, if you lie, it's even better for me because out of the gate, I can say, well, we can just agree right now that you don't know what you're doing and that you need me. And so we'll just start moving this forward. Yes. And like, you can just go. But it's funny because on social media, everybody does well in Bitcoin and all those shit coins. And, I
yeah,
did great. It's just, I don't know. The computer says that very few people did well. So
yeah. It's the same thing with the six figures comment. Is the same thing as like, okay, if only 10% of the population makes six figures, then how does these millions of people make six figures? It's like,
right,
no, you don't. Like,
right.
you don't.
You
You know what I
don't.
mean? I know what it takes to make six figures, and I promise you, you're not.
You're not. And too, just by a conversation, like
Yeah,
just their mind frame will right away, you'll go, this is a person that understands money, or this is a person that understands investing, or this is a person that understands entrepreneurship, or the contrary, they start talking, you go, oh, okay.
yeah,
Like I'm talking to a fool.
yeah,
And so you don't know what you don't know. When you don't know, you show your stripes real quickly.
yeah. Of course, and I would tell people like don't get it fooled. Like people will go like, oh, I'm gonna be a doctor, I'm gonna be a lawyer, I'm gonna be all this, I'm gonna be an engineer. No, I'm gonna make six figures. Even in those professions, it's extremely difficult. Don't get it straight. It's
I
extreme. It's a
mean,
lot of hours, a lot of time consumed.
yeah.
You're not gonna make those six figures easy. And trust
And
and
there's
believe.
no business that you make them easy. I mean, look, if you're a doctor, I suppose, yeah, you're gonna probably come out of the gate making six figures, but you're also coming out with nearly $1 million in debt. And I hope you enjoy
And
140-hour work weeks. And believe
that,
you're not
that
gonna post
that's
that
my
on.
that's my
Right? Yeah,
point.
yeah.
It's
You're not.
like if you're making six figures, you know what I mean? Either you already created a system for yourself,
Yep.
and now that six figures is on autopilot,
Yep.
or you start out the gate making six, but you're working 140 hours a week and you have $1 million in debt on top of you.
That's right. I
Like,
mean, that's a fact, man. And a lot of people can't do that stuff anyway. The lawyer thing really is nothing but, I mean, I'm not going to tell you that the bar isn't difficult or law school isn't difficult. It is. But the truth is, if you're going to be a lawyer, a good lawyer, you're either going to have a lot of connections or you're going to be
yep,
a hell of a salesman. Outside
yep,
of that, you're not going to make any money.
yep.
So that's really not even a great job.
I just like to me, all those jobs, they're important to society, and I commend people that does it. But I just want people to be realize that it's not easy. It's not easy to go to law school. It's not easy to go to medical school. It's not easy to go to engineering school. None of it is easy. And a lot of people think it's easy, and a lot of people think that, well, I'll make that money when I become those things. It's going to be hard. It's going to be difficult, and you're going to work long hours. Even working at Goldman, even working at a financial institution, I had to put 100 hours a week.
Right. Look,
100 hours a week.
my first decade in this business, when I was started off as a financial advisor, I rarely didn't go 80 to 100 hours. That'd be really rare. I didn't do that. That
Yeah,
was just common. That was like what you did.
yeah,
It's not easy, and I still am, and I'm happy, and I have no problem saying I didn't become a master at what I did. I didn't become a master when it comes to like investments until I was probably 10 years in. And let me tell you, I lost my own account 3 times over. It was $100,000 buy-in.
Man, dude, like I
I
can't
mean,
tell
that,
you, and I'll say like I can't tell you in the beginning, at least the first 5 years, how many I probably blown my account like 3 times
yeah,
before
I did.
I figure it out. This is all about compounding.
It is. I
This is
mean,
all about compounding. And to and that's what people don't realize. Yeah, it is a lot about buy and hold, but at the end of the day, it's about compounding your trades, compounding your investments.
100%. People don't. I have a video up that no one watches, but it's on the rule of 72, just demonstrating what compounding does to your money and what 6 years can mean to you, and what throwing an extra $200 in can mean to you. And I think if you should, I always tell everybody before you even worry about investments, because everybody, that's the flashy stuff. That's fun, right? They're like, oh, how do we trade this? How do we move these futures? What's the options? I go, well, that's all the sexy stuff, right? But that is long after you've built a fairly decent foundation in finance. You're jumping into waters that you don't even know if you should be in. You don't even know if you should be there yet. I tell everyone the same thing, and maybe my bias from being a financial advisor like makes me this way, but you have to have a solid financial and investment plan that you understand before you even worry about investments. Like, you shouldn't even go there yet. You have to start with a proper financial plan. How much you make, how much you plan to save, what's your budget like? How do you build an asset allocation model, which is so easy. I tell everybody all the time, it's so easy. My daughter already knows how to do it. She's 11, right? So it's the easiest thing in the world, how to auto rebalance it. And there's really no excuse not to do these things, because everything is free on the internet. I actually built a course for this called Invest Like a Pro, because when you're working with a financial advisor, all he's really doing is building you a financial plan. He's setting you into an asset allocation, and it's kind of a set it and forget it situation. That's what he's doing for you. And it's $500. And I'm like, look, you'll never need an advisor again. That's all he would ever do for you. And I tell them, this is all free things that I just put together for you on the internet. You can go find it for nothing. All I've done is package it for you. I packaged it and put it together, and you have me guiding you through, right? It's like, I don't know how many hours long it is, 7.5 hours. It's video tutorials, but it's fun. Like, it's not painful. But point being is not to pitch what that is. And I'm not even trying to talk about my company, to be honest.
No, no,
It's that,
because like definitely a lot of people needs to hear that because
oh, you can't, if you haven't done that, you shouldn't do anything else.
yeah, a
And
lot of people need to hear that because people get to 40, 50 years old and then there's like, oh man, I burned through so much money. Like
right.
like the
And it was,
average saving, what's the average savings of Americans right now?
I mean, now
Like it's like what, 2 grand?
I don't even know. I think they say something like, I don't remember the numbers, but it's like right now, if 50% of Americans had to come up with 2 grand, they could not do it.
Yeah, they could not do it. I think that like it's something crazy
It's
low
nuts. Yeah,
now.
it's nuts.
It's
Whatever it is, it's nuts. So
it's like it's so bad. And
yeah,
it's like this is at the point of like the lack of financial education.
it really is. And you know, it's such an interesting subject, that subject, because I came from extremely meager beginnings, right? And I've been on my own since I was 17. And it's an odd thing, because I have a unique perspective in that way as well, because I knew when I started making money, even though I was a financial advisor, even though I was a trader, I made every money mistake a human could make, because I finally found myself in a position that I could get the things I always wanted, and I could get them whenever I wanted. And that's that emotional kind of, that we're humans. It's emotional. Like, you're going to be emotional about this stuff. The key is to, like, be 80% stupid and and 20% smart when you're young, and then
Yeah.
as you get older and older, you more shifts into the smart and into the smart and into the smart. And the reason I bring this up is because one thing that in this new social media era that we live in, that I can't stand, is this idea where they'll show like these really wealthy people and they're like, look at their clothes. Like, they dress like they're poor. And it's like, well, I mean, look, can we also be honest that they're all like nerdy, geeky dudes that have no style? They
Yeah.
don't know what to do, right? And
Yeah.
there's nothing wrong with saying, hey, look, when I look like this on the outside, I feel like this on the inside. And then that inside just resonates out to the world, and it brings those people to you as well. Whereas, like, so I always kind of throw in that caveat that, look, there's nothing wrong if you start making money and you haven't had any, that you want to have nice things. You should strive for that. That's an amazing thing to do. Just don't get carried away. Realize that what you make today could disappear tomorrow. So don't put yourself in a position that if it does disappear tomorrow, you're belly up.
And that's something we say on the podcast all the time, is that, you know, people will get a raise, and then the
Right.
first thing they think about, it's splurge time. It's time to
Yep.
splurge.
Right.
It's like you're going, and they inflate their lives.
Yeah.
If they went from making 50K a year to making 80, their inflation on their lives goes to 95,000.
That sounds believable. I don't know the numbers. That
It,
sounds right.
it's just they overestimate, because now they made an extra 30 grand, and now it's like they're spending 10 to 15 grand more than what they make, and
Yeah.
it's kind of crazy.
Yeah.
It's the same thing when people get their tax refund and they go buy a car. It's like you don't really have that money.
Yep. No, I agree. I agree. And that's, again, that's where it has to be some level of balance there. You have to have some level of balance where you're thinking about your future to some extent, right? You always have to be, to some degree. I mean, I'm not one of those guys who's like, and I think like Dave Ramsey, he's a great guy, but he's always talking about getting yourself debt free and then saving your way out of your situation and moving into a new kind of economic status. In his day and age, that was
It was
amazing
possible.
advice. That
Yeah,
it worked.
very possible.
Yeah, it worked. Like, absolutely, that would work. In this day and age, you're going to have to be sharper than that. So you should care about your investments. I am not a buy and hold guy. I don't think that's the way you should do it. If you make all, but pre-assuming you're making all the right moves in your financial foundation, that you have a financial plan, that you have an investment plan, you have a savings plan, and you have a budget. If you have got that in line perfectly, your logical next step is to make sure that the money that you do have, the money that you are saving, the money that you are investing, is doing everything possible for you. That's your next logical step. And where do you start? At the beginning. I mean, the first thing you can learn how to do is just avoid bear markets. It's not an incredibly hard concept. It's something that if you pay attention, you can start doing it. You have to start, then you start building financial literacy into your money. So you've built the literacy into the foundational stuff, right? How to save, how to create a financial plan. You understand asset allocation. You know how it works. You know why people utilize it. And now you say, okay, I want to step it up a little bit. Now, does that mean all of a sudden you shift how you manage all your investments? No, maybe it means 10% of your investments. You say, okay, look, with 10% of my investments, I am going to try to do whatever, X, whatever that is for you, whatever it is. Do you jump right into stock picking? No, but maybe you jump into indexes. You say to yourself, look, the NASDAQ is moving way faster. It could be something this basic. Look, the NASDAQ is moving way faster than the S&P 500. I'm taking 10% of my money and putting it into the NASDAQ. The rest can go to that asset allocation. And then every 6 months, when you look at your NASDAQ, if it's out of whack 10%, you pull that money out and you put it back into your asset allocation. Maybe you just start with that. When interest rates are about to fall or about to rise, I did on the live stream today, I talked about the 20-year treasury via the ETF TLT. It went from 180 down to 50, where it sits now, Kenny. It's down, I forget where it is at this very moment, 48 something or other, 58. I can't remember exactly where it sits, but or maybe it's 9. No, it's at 98 today, 99, because we started buying it at 91.80. But it fell 50%. And at the bottom of that 50% drop, people always say, well, I don't know, like, when are you supposed to buy? How do you know that the selling has stopped? How do you know the price is going to quit falling? How do you know that? Well, there's only one real way to have any kind of thought into when something's done falling or when something is done rising. And that is when you see volume increase by 300% or more. And right now, that particular ETF is trading around 1,000% its average daily volume after it's fallen 50%. There's only one group of people that can do that, and that is institutions. And if it has fallen 50% and you see institutional money in there since the beginning of the year, it is safe to say you should be buying that. That is not a wild concept, right? Like that's easy to grasp. So you can just start learning little things, right? You don't have to buy all
Basically,
like you don't
follow the money, follow the big money,
follow the money. The money is all that matters. Not everything else is BS. There cash flow, supply and demand. We know who holds the supply. It's not like not a conspiracy that the banks and the brokerages bring out the IPOs. Therefore, they own most of the stock that's traded on the index, on any index, right? Because they brought the company out. That's logical. If you're the t-shirt store owner, you own the t-shirts, right? Just because me and my friends come in and buy 5 doesn't mean that we're equal in this thing. You can do whatever you want to that price. And then unless we know what you're doing, and unless we go, hey man, you see what he did at the price of that t-shirt? Well, then don't buy from this dude. We're going to go down the block. All right. So all of a sudden this guy goes, where'd everybody go? I better drop the price again. Same thing in the stock market. So there's the people that control the supply, and then there's the people over there that create the demand. So when you start to see the people that would traditionally control the supply get really active, if it is at a point where price has risen, 30, 40, 50, 60, 70, 80, 100%, that's most likely selling. And it doesn't take a genius to know that. If it's after a 50% price drop, 40% price drop, 30% price drop, that is most likely buying, right? Now, I'm not advocating on this podcast for people to go out there and start actually doing what I just said, because you have to understand how you buy. You don't just buy things all at one time. You scale into positions, out of positions. Kenny, I know you know this, but since I just made that blanket statement, I don't want anyone to think I'm advocating for that, right? There's ways to buy and there's ways to sell. You need to figure that out, but it's a start.
And one thing I do want to say, and I think this is so common in people, is scale up. Don't scale down. Scale up. When you get into a position and it's moving up, buy why it's going up. It's going up for a reason. A lot of people will get into a position, oh, it went down 20%. That means to buy more. No.
That could be a falling knife.
Yeah, that could be a falling knife.
It could be Peloton. It could be Tesla. People also assume, Kenny, just to add to your point right there, man, listen, people think, oh, it's Tesla. It fell 20%. What does that have to do with anything? Tesla went parabolic because everybody got excited about electric cars. It fell 75% following that, right? Peloton, I did a post. It was in February of 2022. If anybody wants to go look it up, feel free. It's on my Twitter. It's at Derek Invest, DEREK Invest. Go check it out. I put a post up of Peloton because I started laughing when I saw it. I just want to see Peloton's quote. And it was like $27. And it had fallen, I forget where it had come from, 180, 190, 200, something like that. It had fallen 83%. And stock analysts, business analysts, and this is across the big firms, there were 33 of them that rated it a buy after it had fallen 83%. You could see that no one was stepping in to buy this thing. And I started laughing. I put a post up and I said, short this to $3 and then short it to 0. And I think today it sits at like 220 because it's a joke. It fell 83%, and now every analyst or every advisor or whomever is telling you to buy, and you think that's reasonable. This is Peloton. Everybody's buying these $2,000 bikes. But it doesn't matter what Peloton is. It only matters was the price rise legitimate based on earnings, based on revenue, or was it based on emotion, excitement? It's 2020. Everybody's scared. So there was this pop for these bikes that no one in their right mind is going to sit in their living room and ride once they go to a gym.
I said that from the beginning. We said that on a podcast back in 2020.
Oh, that's funny.
Peloton was a waste of money because after the pandemic is over, it's just going to sit. You know what it's going to be? A clothes rack.
Right.
It's gonna be a clothes rack, like every exercise equipment eventually becomes. You know what I
That one
mean?
was a funny one because the analyst jumped in and everybody started rating it a buy at 27.50, and that's because their desk didn't get out of it in time. And so that's something I talk about a lot. If you want to know when a price is done dropping, so I'm with you, especially in the beginning, like scale up for sure, but also be aware of like a Nvidia is going to look like Tesla. It's not a Peloton, a Tesla, right?
Mhm.
It's going to look like a lot of these semiconductors right now. It's going to look like Krispy Kreme. It's going to look like you can rattle them off, right? It's not that it's a bad company or that it's not profitable or it's not going to do good things. It's just right now it's all hype. So when you're scaling into something like that, the first time in any given day that you see volume increase by 200-300%, you got to sell out fast. Everything, forget scaling, all of it, because you're playing in an arena that is fueled by emotion. So if you're fueled by excitement, you're fueled by fear. And when you play in those worlds, like in a stock like that, you have to watch scaling up, and you certainly have to watch DCAing on the way down, right? So if you're trying to dollar cost average your way down, there better be a reason for it. And that's
Yeah.
something that
And
you jump
that's
out of my
kind of,
lives, you'll see, Kenny, that I talk
yeah.
a lot about tops and bottoms and how to identify them.
Yeah, and that's kind of one thing I've noticed a lot of people do is like, this is just a bad company. Don't dollar cost average this.
Right.
That's really because like there's very few companies out there that you really need the dollar cost average down. You know what I
Right.
mean? But sometimes a company is just falling 70% because they're just a bad company, and people are just getting out of it. They're
Right.
getting out of it. That's
Yeah.
it. That's all it is. Nothing more, nothing less.
I agree. It is that simple. I mean, if you're dealing in something like Peloton, you know what's going to happen. Everybody knows that's been in the market for any amount of time, right? And when you deal with a Tesla, it hasn't. And again, this is why when I talk about the market, the way I always say it, Kenny, is the market itself is a business, right? The structure of that business is companies. Those companies trade based on mechanics. Those mechanics elicit emotional responses. If you can understand where their mechanics are, and then you understand why it's being used, they're really easy to follow. But is that something I just like learned overnight? No, hell no. It took a long time. And that's why in my lives, I'll move slow and I try to explain a lot, but it's difficult, right? Like you're trying to teach someone not just what position is good or what position is bad, but how would you get into it? How would you get out of it? Everybody's so different. And so I really hammer away at that too, because whether it's a good company or not, it can still scream 3,000%, right? It doesn't
Man,
matter.
man, dude, we got into so much. This was a wonderful podcast, man. We gotta might have to schedule you in like a week or so.
I'm
Might have to
happy, man. Happy to do it.
happen to pencil you in again because this was really good, really informative. But we gotta hop off. I'm hitting that like 45-minute mark.
All
But
right.
everybody, Derek Miller. I don't know if you have any like social media handles, any.
I do. Twitter is Derek Invest, DEREK Invests. All of my other handles are Derek Miller, DEREK MILLER, just as you see on the screen, Invests. So you can find me on almost everything, right? So I'm on LinkedIn as Honest Trader. I'm on like Facebook, Instagram, Twitch, Kick, Daily Motion, YouTube.
You can
And
find them anywhere.
if you
You can find,
look for Derek Invest, I'm going to show up.
yeah, you can find them anywhere, man. I appreciate you guys listening, and I appreciate you guys tuning in. Thank you, Derek.
Thanks, Kenny.
Peace.
All right.